All right. Hope you guys had a great weekend. Just going to dive right in. Going to do a shorter session today, covering a few companies that I'm following. So Palantir last week had a nice pullback prior to earnings, followed by a nice recovery as well. Hit a low of 1705, recovered to 20 and change. Now we're looking like we're going to see an uptrend to around, I'd say probably 24, 25-ish in the next month or so. Very solid report from Palantir. I think we see that area again, 24, 25 area. Looking at the option chain right now too. We analyze some ideas on how to trade it. Chains right here. So we can see that if you go out about a month, I would say go out to at least August, because right now you can't buy July contracts. So August expiration, you can buy, for example, the $20 call options and sell the $25 call options. Net debit right now is about $1.50. Maximum reward is $3.50. Break even is $21.50. Right, that's what I'd play it probably for August option expiration. 3 months out, it's a lot of time, right? Alternatively, if you want to leg into it, you could buy the August expiration first, wait for a rise in price, and then sell the higher strike expiration, higher strike contract. That would reduce your overall debit perhaps down to as low as, nothing, right? Let's say, for example, we run to 25 in the next couple of weeks and you bought the 20 strike already, then you could sell the 25 strike for about 250 as well on elevated IV plus call skew as well. That perhaps could give you a play where you make $5 with no risk at all, right? Alternatively, if you want to enter the stock at a lower price, say you want to get back in at around 17-ish, which was the low of the week, you could sell the $20 put options at the money put options a couple months out. Again, you won't see rapid time decay here, so you might want to go to July. You need to wait until after this Friday for July to pop up, but that might be a good way to play it on cash secured puts, right? Next thing we're going to look at is AMD. Let me pull up that option chain right now, one sec. Actually, the chart. So just want to point something out here. So AMD on the 1 year time frame on the weekly candles right here, right? One thing I noticed was that we have not seen 4 red weeks in a row. So last week was the 3rd red week in a row. We've seen that happen twice this year. So once over here where it fell from a high of 94 on week 1 to a low of 74.20 on week 3. On the 4th week, we recovered to 81.89 high, right? Prior to that, we had 3 red weeks in a row as well, where we had a high of 86.09 on October 12th. On the 3rd week, we hit a low of 74.23, kind of like we hit last week, right, roughly. And the following week, we had a nice big green candle to 86. So now what I'm seeing is that we're going to perhaps have a nice recovery to the upside. And that recovery could come as high as $80 by Friday. We had a dramatic pullback. The lowest closing price we saw in the past roughly 10 months at 72.50. And the recovery, I think, will be very, very sharp, kind of like a rubber band. You pull it back hard, it snaps back fast, right? So looking at AMD, I would say you're going to want to look to buy some time on it as well, right? Just to be safe. So looking at the option chain on that, pulling it up right here. I'll go out to at least July, perhaps even August, right? So if you go to July, for example, and you want to catch a recovery to perhaps 85, for example, you could go to the strategy builder and you could buy the 80 strike call option. Again, I'm going out of the money here just because the potential for a fast recovery up to 85 area is very, very high probability event given how far we've fallen. Keep in mind, after earnings, which were great, the stock price fell from 89 down to a low of 72 and change, right? Typically, the recovery is about 50% from that low level, which would imply roughly a $8 move to the upside, right? So the low is 72 and change. Upside should be around 81-ish, roughly, right? So if you go long, again, the 80 strike, and you go short, the 85 strike, you're risking about $1.10 for maximum profit of $3.90, right? So pretty solid risk reward. Break even is 81.10, and if it recovers up to 85, you make full pop at $5 minus 110, so $3.90 profit, right? That's how I play it there. AMD is very, very oversold right now, as we saw on the chart previously. I'm in it pretty heavy right now, and I like where it's at right now. Moving on to Alibaba. So Baba had a terrible week as well. They pulled back on earnings. One second, let me change charts here. So we have Alibaba over here. So again, analyzing on the weekly time frames as well, right? Baba has not had 5 red weeks in a row all year, right? And when we've seen it pull back 3 weeks in a row, typically it pops back up a little bit. So the only time we saw four red weeks in a row was back from November 30th on when it was at a high of 271.30. 4 weeks later, hit a low of 211.23. The following week, the stock price recovered pretty sharply to a high price of 243.39. So right now we've fallen from 5 weeks ago, we were at 245.69, and now we are at 209.51. Also very, very near the 200 support area, right? Keep in mind the low of the year was 196.70, right? They had a decent report last week. They missed EPS because of that one-time fine that China levied on them, right? Chinese government. So that could be a pretty good recovery play on Baba. Like, I think they're a very, very good value stock right now, given how low the PE is for a big tech company. And we should see a recovery back to 240, I would say pretty soon, right? So keep an eye on Baba as well. The way I'd play it probably is buying, again, out of the money call spreads, just because they are quite cheap right now. And again, if the market does pull back at all, the risk reward is very favorable right now, so you won't get burned too badly. But keep in mind, you want to manage your risk pretty well, right? So I'm going to pull up the option chain on Baba so we can see it. Give me 1 second. Here's a chain right here. So again, you want to look at least a month out. I'd say July, perhaps even August. August might be a more favorable expiration date to focus on, right? And if you're going with spreads, you might want to, for example, buy the 220 call options and sell the 250 call options, right? So give yourself a nice big wide spread, and you're gonna have a debit of $7, break even 227. Maximum profit is $23. So you have over 3-to-1 risk reward on the position itself. And as I mentioned previously with Palantir, if you waited for a recovery after buying the call option long, so for example, let's say you bought this 220 strike call option first, wait for recovery to around 230 or so, which could happen in a couple of weeks, and then sell the 250 strike call option, you might even get your debit down to about $3 or $4, right? So you're risking 3 or 4 to make 26 to 27 instead, right? That's probably a better way to play it. Looking at a few other names like Riot, for example, and Mara, because I know people were asking me about that this week. Crypto is pretty much moving in huge swings in other directions, so very, very volatile right now. And trading Riot and Mara might not be the best way to play it, just because they're very, very speculative, right? I would probably stay away from these names if you're not already in them. If you are in them, sell covered calls because of the high IV. Right now, for example, I know some of you guys are holding some stock. If you're in, for example, Riot, you can sell the 1 month out covered calls on Riot, at the 40 strike for $1.50. Or if you want to go, at the money almost, you could sell the 30 strike for about $3.35, right? So pretty nice premium intake there of about 10% of the stock price right now. If you sell, the 30 strike over here. But you need to be okay with losing it at $30 or so. Otherwise, I'm not really interested in owning these two stocks, Riot and Mara myself. But again, if you already own it, that's your choice. I would capture some of the premium on the upside with the high IV right now using covered calls, right? Disney also fell last week pretty heavily after earnings, right? Here's the chart on Disney. They had a decent report, but their growth numbers on Disney Plus weren't as expected, because they previously had much better numbers than expected. So obviously the growth is declining a little bit, right? But that being said, a lot of their content has yet to be released because they're waiting for everything to open up, because they want to be selling merchandise at the same time that movies are released, right? Which makes sense. And also the theme parks will be opening up as well, right? So might not be a bad idea to go long in Disney on the pullback over here, right? We broke below support at around 180 or so. Now next level of support will be around 160. That's where I'm targeting ownership, perhaps, if we get a further pullback. Again, if you want to use cash secured puts, you can do that to own the stock at a cheaper price. And what I would do is look at the June 18th expiration contracts at around the 170 strike, for example. You can sell these for about 355 right now. Effective ownership of the stock price would be around 166.50 or so, right? Again, Disney's a stable company. They are essentially now an amalgamation of Netflix plus their theme park business as well, right? And keep in mind that will bounce back once COVID is over, right? And obviously we're seeing a lot of progress there too, right? Alternatively, just looking at SPY and Triple Q as well, right? So SPY had a very interesting week last week, massive pullback on those inflation numbers. Again, inflation came in at 4.2% on the core CPI. A lot of that had to do with used car sales going up about 21%. Regardless, everyone sees that everything's more expensive now, and we're seeing that firsthand in the labor market, where McDonald's and Chipotle are offering much higher salaries than usual right now, right? I mean not salaries, but hourly rates, right? And that's a function of the landscape we're seeing right now in the job market, where in the U.S. unemployment is paying typically better than being employed at minimum wage, and in Canada, same thing, right? You know, we have a CERB up here, which is equivalent of the stimulus plan in the U.S., and it pays $2,000 a month to Canadians that are unemployed, right? So the incentive to not work is pretty great, which is why these lower wage jobs are offering to pay more right now. So Chipotle, Starbucks, McDonald's, they're kind of leading the way, so to speak, in raising the hourly wages and offering incentives to join those companies as well, right? Like you know, signing bonuses and whatnot, or referral bonuses and stuff too. But SPY right now had a nice big pullback last week to 404, which is kind of unfortunate because it was very close to filling that gap at 400.61, right? And how we fill that gap, I'll be very bullish on SPY, but given that we have not, I got to be bearish short term and be inclined to think that we're going to see a pullback down to 400 again on SPY, which is about a roughly 4.5% or so decline from the current price, right? Obviously, just my analysis and my thesis, I wouldn't actually act on it if you guys are not already long. If you're long, you might want to be hedging a little bit, or you might want to scale back your positions a little bit as well, depending on what you're in. But a lot of these heavy growth stocks have gotten smashed in the last few weeks, namely the ARK ETF. So you have ARK Q, for example. Here it is, ARK Q, right? So it's pulled back from about 100 down to 75 this past week. So shaved off about 25% or so at the lows, 27% at the lows, right? You have ARK K as well, right? And ARK K pulled back from 160 down to below 100 in the last couple months. That's a decline of about 40%, right? So you got to think that some of these names are going to be decent buys. But again, a lot of names that are being beat up right now are names like, you know, CrowdStrike, Datadog, Cloudflare, that kind of stuff. So like, you know, you can see these charts, right? So here's Cloudflare, for example, right? I'll put it back on the daily charts too, so you can see. So Cloudflare has fallen from a high of 95 to a low of 65, recovered up to 72 or so in the last couple months. Then you have Datadog right here, right? They've fallen from 120 down to a low of 70, up to 83 or so. You have CrowdStrike over here as well. They went from a high of 250 down to a low recently of about 180, recovered to 192 or so. You know, a lot of these names they're growth companies, but they're very, very overvalued, right? Regardless of their growth trajectory right now. So you want to be kind of cognizant that in an inflationary environment, money costs more, and as rates go up, obviously, which is to be expected with inflation higher. And as a result, these growth companies will have a harder time borrowing money, which means their growth rate will actually suffer as a result, right? Also, the value of their future cash flows is lower as well. So keep that in mind too, right? So the short thesis here is that if you are going to be investing going forward for the next couple of years or so, I would be looking at stocks like Disney, for example, or AMD, Alibaba. You know, Palantir is more of a growth stock too, but again, I see value there in the long run. But again, you know, looking at the PEs of Alibaba, AMD, etc., just for perspective right now, right? So for Alibaba, for instance, they are trading at a price earnings ratio right now of 24.72. Forward PE is 16.7. That is extremely low for a tech company, right? They're currently worth $560 billion. they're generating net profit this annually of 23 billion right now. Sales are 111 billion roughly. Just contrast that, for example, with Amazon, right? So Amazon is worth 1.6 trillion dollars. They're doing sales of 420 billion, so about 4x the amount of sales of Alibaba, and their net profit is 27 billion, whereas Baba's is around 23 billion, right? So the valuation is very, very stretched, Baba versus Amazon, yet Baba is still doing pretty much as well as Amazon. Obviously, you got to give them the China discount because of, obviously the potential for fudgy accounting practices and whatnot. But at the same token, I see great asymmetry of risk in going long on Baba from here. Also with AMD as well, which I mentioned prior. Currently, price earnings ratio is 31.66. Forward PE is 27.51. Price of sales of 7.78. They're currently worth 88.81 billion. Their net profit right now is about 3 billion, and sales are 11.42 billion. Contrast that with NVIDIA, for example. NVIDIA is worth over 3 times that of AMD at 340 billion. Their net profit is 4 billion and change compared to AMD's net profit of 2.9 billion, right? So again, very similar metrics overall on profit. Sales, NVIDIA takes the cake, obviously, at 16.68 billion, but AMD is no slouch at all. They're at about 11.42 right now, right? So what I'm saying is that look for value in the market right now where it's being offered, and the value that's being offered is in names like AMD, Alibaba, perhaps even Disney as well, right? Disney's current forward PE ratio is about 35, but again, with Disney Plus kind of taking a leap forward faster than expected, that could be a big surprise going forward, especially if they start launching some of their bigger movies like Marvel movies, for example, on their platform. Yeah, that's pretty much it today, guys. If you have any questions, I'm going to stop the recording right now. We can do some Q&A, but if you like the video, hit the like button and share it with someone that they think I might appreciate it. If you have any questions at all, just put a comment below and I'll answer when I can. Otherwise, have a great week and trade safe, okay?